All right, so we've gotten a lot of questions on this. If I'm an S Corp or an LLC, should I convert to be a C Corporation? Just a couple things that come to mind when we're talking about this for a client. Really the number one priority is to think about the long-term strategy of the business. And what I'll say is it's very easy to become a C Corporation. The IRS and state law, Delaware, Maine, really anywhere, make it really easy to form a C Corp, and it's typically tax-free to get your business into one. On the other hand, it can be very difficult or very costly from an income tax perspective to get out of your C Corp structure. And I guess one other point I'll make is if you're thinking about becoming a C Corp and hey, maybe we'll go back to being an S Corp when the money makes sense again. Once you convert to a C Corp, you may be locking yourself in for about 10 years before you can get back to your single level of taxation. And that's because once you blow your S election and become a C Corp, you have to wait 5 years before you can make another S election. And then from there, when you go back from C Corp to S Corp, you have the built-in gains tax, which sunsets over a 5-year period beyond that. So just something to think about, that you can't really go back and forth and play the effective tax rate game on a short-term basis. And the other thing there is if you're thinking about selling your business in the next few years, it's worth considering if you're going to have to sell the assets of the business, which is very common for Maine businesses to really be selling in an asset deal rather than a stock deal. If you convert to be a C Corp and you can't sell the stock and you have to sell the assets of your business, you could be looking at a pretty hefty tax charge to sell the assets out of the C Corp and then get the cash out of the C Corp to yourself. Ben mentioned when we started off here that we really don't know what the tax rates are going to look like 5 years from now, 10 years from now. 21% sounds great today, but it could be back in the 30s before too long. And I'll skip the international tax stuff for now because we're running short on time. So let's look at what this means from an effective tax rate perspective. All right, so pass-through income is really going to be at the individual rates. Let's assume we're not going to get any of our 20% deduction here for this pass-through income. So our federal income tax is going to be at 37%. State income tax is going to be 7.15%. That's our main rate. These are maximum tax brackets, by the way. So keep in mind, this is not including any 20% pass-through entity qualified business income deduction. So let's move on to the second example where, assuming here, we're going to get a full 20% deduction for our pass-through entity as qualified business income. So the federal income tax is now 29.6% rather than 37% on the individual income that we're getting passing through our business. So when we put all these numbers together, the tax on operations in the middle here, it's still much higher as a pass-through entity, but it's not as bad as it was before. It's not 47%. But then when you look down, same cost on the corporation side to get the cash out, that 2-3% difference between the S Corp and the C Corp now being a 10% effective tax rate difference. If you're pulling your money out and you're going to get the qualified business income deduction, you're going to really hurt yourself being a C Corporation down the line. All right, so just a couple other things to think about if this is really in the cards. We have our effective tax rates. These are maximum brackets, and we're really just taking a high-level shot at it, right? But Ben mentioned at the beginning of the presentation here, everyone's business, everyone's 1040 looks differently, and how all of these new changes is going to impact their effective tax rate is really going to be very individualistic. So we got to think about, is the interest expense limitation going to mean anything? Do I own multiple businesses? Would it be beneficial for me to hold things in a pass-through so I can offset and take more interest expense deduction? The C Corps are kind of blocked in, so if they're limited at the C Corp level, it's just going to carry forward. That deduction won't be there. We got new bonus depreciation rules. How does your CapEx plan impact what your structure should be? On the other hand, deductibility of state taxes. Individuals can't deduct state taxes anymore, but corporations sure can. But that deduction is now worth only 21% rather than 35, 39%, depending on where you were before. We don't have corporate AMT. And I talked about the cash distributions a lot with those models. What you really want to think about, and the number one question to me is, do you need the cash to come out of your business? could you leave it in for aggressive expansion, growth of the business, or do you have a lot of debt and you want to leave the cash and the earnings in there to pay down your principal? If it makes sense for a long-term strategy to pay down debt or leave a bunch of money in the business, then I think it's really worth looking at if the numbers make sense to convert to C status. And I kind of talked about this stuff already. You got to look down the line. Are you considering selling your business? And then the cash distributions, really on an annual basis, where's the cash need to go?